Ladies and gentlemen, good day and welcome to Alicon Castalloy Limited's earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani from CDR India. Thank you, and over to you, Mr. Vaswani.
Thank you, Michelle. Good morning, everyone, and thank you for joining us on Alicon Castalloy Limited's Q2 and H1FY25 earnings conference call. We have with us on the call today Mr. Vimal Gupta, Group CFO, Mr. Shyam Agarwal, Chief Marketing Officer, and Mr. Rajiv Gupta, Head of Business Development at Alicon Castalloy Limited. Mr. Vimal Gupta will provide an overview of the operating and financial performance for the quarter and half year, following which Mr. Agarwal will walk us through the operating highlights. Mr. Rajiv Gupta will then provide insights on domestic business and developments in the global markets. Thereafter, we shall open the call for the Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared with all of you earlier. I would now like to hand over the call to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good morning and welcome to our earnings call. We appreciate you taking the time to join us on a Saturday. I hope you have had a chance to review the earnings documents shared earlier. We are pleased to announce that Alicon has achieved record-breaking quarterly revenue of 465 crores for quarter 2, making the fourth consecutive quarter in which revenues have surpassed the 400 crore mark. This growth has been contributed by segments of passenger vehicles.
Sorry to interrupt, sir. You're not audible right now.
Now it is audible?
Yes, sir. Can you please repeat your last line, please?
Yeah. So we are pleased to announce that Alicon has achieved a record-breaking quarterly revenue of 465 crore for quarter 2, making the fourth consecutive quarter in which revenues have surpassed the 400 crore mark. This growth has been contributed by segments of passenger vehicle and two-wheelers and supported by traction of non-auto segment. Revenues from both domestic and international market have grown, supported by our strategic focus on developing new technology platforms, expanding into new regions, and prioritizing value engineering and capability enhancement, all complemented by positive trends in our established lines of business. Our business momentum remains strong, outpacing both global and domestic automotive industry growth. We are engaged in advanced discussions with a number of high-profile clients, including leading global OEMs and Tier 1 suppliers, who are drawn to a high-quality, competitively priced solutions we offer. Alicon's differentiation is
I'm sorry to interrupt, sir. We are not able to hear you. Ladies and gentlemen, the line for the management has been disconnected. Please stay connected while we reconnect them. Ladies and gentlemen, thank you for patiently holding. The line for the management has been reconnected. Over to you, sir.
So sorry for this disturbance. Alicon's differentiation is anchored in our expertise in low-pressure die casting and gravity die casting, processes that are gaining wider acceptance among our clients. Additionally, we are steadily transitioning from supplying as cast products to providing fully machined components, evolving from a casting provider into a solution provider. This shift will increase value addition and enhance our overall margin profile. Our progress can be tracked through the three key metrics. The share of passenger vehicle and commercial vehicle in our product portfolio continues to rise, now accounting to 51% of sales in Q2 of FY25 compared to 49% in Q2 of FY24. Our customer base has evolved significantly, adding prestigious global OEMs and Tier 1 companies, reflecting Alicon's growth industry stature. We continue to expand our client roster each quarter. Our investments in design, R&D, and value engineering have positioned Alicon as not just a supplier to build-to-print components, but as an innovative solution provider recognized for technology and design excellence. Based on strategic initiatives undertaken, Alicon has transformed substantially from 2018 to 2024 in the following manner. In 2018, we were heavily reliant on two-wheeler customers. Today, we have a well-diversified portfolio, including passenger vehicle and commercial vehicle. Our customer base, once primarily domestic, now includes major global names and leading Indian OEMs that have themselves scaled significantly. Our product portfolio has expanded beyond cylinder head to include a range of critical components. This diversification has improved our margins profile from 8 to 9% in 2018 to around 13% at present, with ongoing efforts to enhance it further. Turning to our financial performance for Q2 and first half of 24-25, we achieved revenues of 465 crore, representing a 22% increase from 382 crore in Q2 of FY24. This growth was fueled by the scaling up of production for new parts, notably for passenger vehicle customers. There has been a recovery in volumes of two-wheeler too. The gross margin for Q2 of FY25 was 47.55%, down by 253 basis points from 50.07% in Q2 of FY24, reflecting the change in our product mix, which saw a bit of moderation in sales of commercial vehicle segment, offset by strong pickup in volumes of two-wheeler segment. Employee costs rose by 5% year-on-year, driven by salary increment, higher minimum wages, and new hires aligned with our growth. If you compare employees costs for Q2 of FY25 with Q1 of FY25, you will notice that this has declined 5% quarter-on-quarter basis. The reason is that the higher costs temporarily higher in our European operations have completed their tenure, and we are back to regular staff levels in Europe. The EBITDA for Q2 of FY25 came in at 57 crore, up by 21% from 47 crore in Q2 FY24. With a margin of 12.2% compared to 12.3% last year, higher volumes of two-wheeler products and reduction in higher value-add products for commercial vehicles has impacted the sales mix this quarter, which moderated the gross margin and in turn has impacted EBITDA margin. We are pleased to share that despite these factors, the impact on EBITDA margin is modest 9 basis points. On a sequential quarter basis, we have seen that the EBITDA margin moderated from 13.2% in Q1 to 12.2% in Q2 of FY25. This is again due to the shift in product mix, resulting in an impact on gross margin, which has flowed through to the EBITDA margin. Compared to Q1 of FY25, EBITDA of 58 crore, the absolute EBITDA of 57 crore in Q2 signals another strong quarter. Finance costs increased by 11% year-on-year to 11 crore, driven by higher borrowings and 9% sequentially from Q1 of FY25. Depreciation rose by 26% to 23 crore, reflecting investment in machine and tooling. Pre-tax profit, the PBT, grew by 20% year-on-year to 23 crore, up from 19 crore in Q2 of FY24. So net profit, the PAT, for Q2 FY25 was 17 crore, a 16% increase from 15 crore in Q2 FY24. For H1 financial year 25, total revenue reached 905 crore, up 23% from 737 crore in first half of FY24. Gross margin was 48.8%, down from 50.2% in H1 FY24. EBITDA for H1 stood at 115 crore, a 32% increase year-on-year. And the profit after tax for H1 of FY25 was 36 crore, as increased of 49% year-on-year basis compared to 24 crore in H1 of 24. Our Q2 capital expenditure total approximately 54 crore, and for H1 capex is around 100 crores. Focusing on machinery and new product development. For FY25, we anticipate capex of around 150 crore, underscoring our growth initiatives. Coming to our earlier guidance of 1800 crore for FY25, targeting 15% growth. We are seeing signs of softening of demand in India as well as in markets such as Europe and USA. We are closely monitoring the situation and will update on this in Q3 as we get more clarity on OEM schedule. Despite the cautious tone for the immediate future, we remain excited about our prospects, bolstered by ongoing client discussions. While current sentiment around electric four-wheeler is subdued, we are well positioned in hybrid technologies with promising engagement with domestic leaders like Toyota and Maruti. With that, I will now turn the call over to Mr. Shyam Agarwal for the operating highlights of the quarter.
Thank you, Mr. Vimal. Good morning, everyone. I am pleased to share that we once again achieved our highest ever quarterly revenue in Q2, marking the fourth consecutive quarter with revenue surpassing 400 crore. Alongside a 22% year-on-year revenue growth, we also posted healthy increase in both PBT and PAT. This performance underlines our strong momentum as we progress through financial year 24-25 on a solid trajectory. This quarter performance is more impressive when viewed in the context of a decline in the global automotive market. In Q2, global production was lower by 4% on YOY basis. In the same period, the Indian automotive market has reported an increase of 9% in overall vehicle sales, driven by the recovery in two-wheeler sales despite a decline in passenger and commercial vehicle segments. Against the decline in the global market and modest single-digit growth in the India market, Alicon achieved a solid 22% increase in sales. This includes 59% YOY growth in the passenger vehicle segment, a 19% rise in the two-wheeler sales, and 28% growth in sales to the non-automotive segment. Contribution of the CV segment has declined, aligning with the segment's overall volume reduction. This quarter saw continued momentum with Maruti Suzuki, driven by an increased ramp-up in cylinder head supplies to support an additional model and the commencement of deliveries to their Gujarat plant. As anticipated, this resulted in higher volumes supplied to Maruti Suzuki. At the beginning of 2024, we initiated the supply of cylinder heads to Stellantis India. With a successful ramp-up in Q1, I am delighted to report that this momentum continued into Q2 with a further scale-up in volumes. Consequently, Q2 marked our highest ever supply volume to Stellantis, significantly surpassing Q1 level. Toyota maintained its steady demands for cylinder head for their four-wheeler hybrid models. Toyota has planned a new TNGA line capacity expansion from January 2025, for which in-house line modification has been planned in November. The modification will require shutdown for a brief period in November, but the line expansion will result in higher volume requirements from Q4 onwards. The strong performance of hybrid models from both Maruti and Toyota, coupled with scale-up of volumes in Stellantis, has enabled the growth of 59% YoY in the PV segments. In our European operations, the battery housing product for hybrid vehicles that we are supplying to Samsung, a Tier 1 supplier, is progressing well. This product is supplied to 3 different vehicle models and volume has stabilized after ramp-up in Q1. Last quarter, we highlighted a development project for Volkswagen autonomous driving initiatives with ADAS technology set for widespread adoption across the automotive industry. This venture positions us to tap into a high growth market segment. Our success is delivering a precise design and specification on the first attempt has earned high praise from Volkswagen. The Volkswagen R&D team has recommended us for the future part development activities. We have positioned ourselves to capitalize on the large trend defining the auto industry today. Today, we supply nearly 90 components to the EV industry, with our European plant providing a strategic advantage in advanced tech capabilities. Our expertise in the thermal engineering has set us apart, exemplified by the EXL development for Jaguar and Land Rover. While electrical vehicles have witnessed early success and generated a lot of buzz, there are now some concern over charging availability and range, as well as battery replacement and resale value. As a result, hybrid vehicles have now started to catch up in terms of interest generated due to their position as a practical bridge between traditional and fully electrical vehicles. In the first 9 months of the calendar year 2024, hybrids recorded higher sales growth than EVs in key markets like Europe, USA, as well as in India, driven by consumer preference for their flexibility and compatibility with existing fuel infrastructure. A global automaker like Toyota has invested significantly into hybrid production, positioning hybrids as a pivotal growth segment in the automotive industry. And in India, Maruti Suzuki among the leaders to incorporate this technology. With a strong portfolio towards this segment, we are well positioned to capitalize on this trend also. Another element of our growth strategy is to increase the share of customer wallet. We are doing this by pursuing more contracts for end-to-end fully machined parts. As the proportion of as-cast parts reduces in favor of fully machined parts, there will be greater element of value addition. Our customer value proposition is rooted in technology-driven innovation, powered by our state-of-the-art Advanced Technology Center. Equipped with high-end machines and driven by a team of 20 researchers, the center spearheads R&D, delivering groundbreaking, cost-effective, and eco-friendly products and processes. Recent additions to our technology capabilities includes the state-of-the-art cold core box manufacturing facility at our Shikrapur plant in Pune, enabling the production of high-precision components that meet stringent industry requirements and strengthen our market position. Integration of robotic arms into production processes, enhancing precision, efficiency, and safety while ensuring consistent quality and improved output. Integrating advanced digital process control across our operations, leveraging machine intelligence to enhance precision and efficiency on the production floor. These controls provide real-time data and actionable insights, enabling smart decision-making and aligning our processes with global best practices to meet the evolving needs of our customer and products. We have added AI and IoT into our operations, which has contributed to productivity enhancement as well as reduced rejection rate. This helps in optimizing manufacturing processes, making them more efficient and responsive to real-time data. Moving up the value chain, we are now working on highly complex HPDC parts with the aim to shift the process architecture into LPDC, highlighting our exceptional design and technology prowess. Transition from high pressure to low pressure die casting enhances structural integrity, detail precision, and material efficacy, meeting diverse customer needs while advancing sustainability goals. In fact, we are striving to enhance sustainability through multiple initiatives. Transitioning products from HPDC to LPDC reduces power intensity and minimizes waste, while our new model plant and automated facility optimize resources use. Alongside water conservation efforts, we are diversified our energy mix, with solar panels at our India and Europe plants now generating 1/3 of our energy from renewables. We aim to increase this to over 50% by next year, further enhancing resilience and cost efficiency. With that, I will now hand over to Rajiv Gupta for his comments. Thank you.
Thank you, Mr. Shyam. Greetings to all of you. In Q2 FY25, global auto industry witnessed 4% YOY degrowth in volumes. Within this, there was 1% growth in North America and South America markets. Degrowth of 25% in Middle East and Africa, and Europe volumes declined 4%, China degrew by 6%, South Asia down by 3%. In the contrast, the Indian auto industry reported a healthy performance with 9% volume growth driven by the two-wheeler segment. Analysis of the growth by segment indicates 12.5% growth in two-wheeler segment on a year-on-year basis, 0.7% degrowth in the passenger vehicle segment on a year-on-year basis, and 13% degrowth in the commercial vehicle segment on a year-on-year basis. Auto volumes would have been better in Q2, but the Shraddh period negatively affected sales. Despite the weakness towards the end of the quarter, two-wheeler sales posted growth of 12.5%, with the momentum continuing from earlier quarters. Within this, scooters growth was 16.3% YOY, while motorcycles grew by 10.7%. This growth was largely driven by recovery in the rural market and increased financing penetration. For Q3 FY25, the market outlook remains positive, bolstered by ongoing rural recovery and expectations of festive season demand along with expected offtake from the wedding season sales. In the passenger vehicle segment, utility vehicles continue to witness favorable momentum. Further, the segment around EVs is somewhat subdued, while demand for hybrid vehicles remains strong. Having built up offerings for hybrid vehicles, we are well positioned to take advantage of this trend. In Q2 FY25, the retail volumes of commercial vehicles declined further due to the seasonal slowdown around monsoon and is expected to improve slightly in Q3. Coming to the business wins, in Q2, we added 13 new parts from 5 existing customers. This includes 5 parts from the carbon neutral segment, 7 parts from ICE, and 1 part from a structural business. Of these 13 parts added, 6 parts pertain to the domestic business and 7 parts for the international business. The 7 parts of the international business cater to requirements of a marquee global customers like Scania, Taco, JLR, Daimler, and Honda Cars. This includes another order win for a structural part for Jaguar. This is a significant win with around rupees 850 million over a lifetime. We expect the balance in our product mix to improve further as all of the new business that we have won this quarter is supplying parts for a four-wheeler, which we align to a strategy of focusing on a higher value parts. The global business contributed to 23% of the total revenue during the quarter. Further, 94% of our business is from auto and 6% from non-auto customers. During Q2 FY25, Alicon booked new orders aggregating rupees 37 crore. The new business added is aligned to our strategy of higher value, and as it is all towards the four-wheeler parts supplies. With this, our total new order booking has surpassed 9,000 crore, which is executable over a period of 6 years from 23-24 up to 28-29. On this note, we can open the floor for questions.
Thank you very much, sir. We will now begin with the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Umesh Matkar from Social Financial Services Limited. Please go ahead.
Yeah, thank you very much, sir, for giving us the opportunity. So my first question would be the gross margins were down 200 basis points. So if you can elaborate on whether there was a change in composition.
So the main reason we have explained that there is a decline in the commercial vehicle because change of the sales mix. Because the commercial vehicle where we are having the higher margins and major contribution for our exports, there we have seen some decline, softness. And on the other side, there is an increase in the sales of two-wheeler. So where the margins are, especially on the gross margins, are lower. So that is the main reason for this some decline in gross margins.
Okay, and so do you expect the composition to change going forward?
Yeah, definitely, because you know that auto industry, some softness is there in the exports, especially the US market, what we are seeing in the Europe market. So
Right.
hopefully, maybe next 1 or 2 quarters, I think there will be some softness. After that, we are seeing the good recovery.
Okay. So, and what would be the impact of US CV and global EV slowdown on us?
Yeah, Mr. Umesh, thanks for the question. On the commercial vehicle, if you see, the more impact is in Europe and a little bit impact in the USA. If you see for the commercial vehicle, so
Right.
there we are seeing some of the customer or rather all the OEMs. They are seeing that the demand is not there. However, there are new Euro norms are coming in 2026 and 7. So
Okay.
there may be a pre-buying because the cost of the vehicle will increase. So there may be impact that pre-buying may come in the next year. So we are hoping and we are keeping a close watch on the EDI release, which comes every month from all OEMs. So we will keep a track and maybe in the next phone call, we will be able to give you a much clearer picture because by the time of the next con call, we will be having the yearly projections also from the European customers.
Okay. Thank you. And so what are the new logos added or contracts signed during the quarter?
Yeah, as Rajiv has explained,
Right.
so we have, in the con call, so we have added the new businesses from Jaguar and Land Rover, then Scania, then Taco, So these are the new customers from where we have got the new businesses.
Yes, sure. So, and any view on life beyond FY27, if you can give us, and also 2,200 crores, what kind of business plan we are shaping up? Any color on the same, if you can give us, that would be very helpful.
Umesh, very good question, actually. But I tell you, we will be in a better shape in the next con call because we will be compiling all our yearly projection for the next year and the forthcoming year. Secondly, you know that lots of global events are happening, like the election in the US, the softening of the Europe and the US market, then the tension in the Middle East. So global market is very volatile, and we are seeing the government spending in India is also down in this financial year. So we also expect that something should come in the budget. So maybe we will be having more inputs, more detail for you in the next call.
Okay, sir. Sir, Middle East, there are some issues going on. So any impact that we are having on the business, and are we seeing it that reducing it?
Umesh, I tell you, it is having the impact, no doubt. We can see sometimes the freight cost to our Europe and USA customer that keep on changing, and as well as the lead time for the freight, what we are supplying, that increase or decrease. So it impacts the businesses with respect to export that we are seeing. And also these things impact the cost of the fuel. The crude rate increases with the tension in the Middle East, you know very well. So these things are having the impact, and more confidence of the customer confidence comes when there is a peace in the, globally. So we see it should improve as victory with the Trump. He already said he will work for the peace globally, including Russia, Ukraine. So we are keeping our finger crossed for the better global environment.
Okay, thank you. Sir, our medium-term goal of attaining 15% EBITDA margin and 20% ROC is in track. So, or is there any change in this?
No, we are on track and the target is clear. Only that due to some little bit softening in the market, that for short term there is the impact we are seeing. But definitely, because as per our order book, the kind of businesses we have already booked and the kind of margins these businesses are having. So I don't see any impact on that in the coming years.
Okay, that's good to hear. So what is the contribution from the high pressure die casting in H1?
No, we are not in high pressure.
Oh,
we are doing the low pressure, gravity, and some sand casting.
Acha. Okay. And will new parts starting production in Q3, Q4 offset overall slowdown in EV and CV?
Umesh, as you know, in the automotive industry, when we acquire new businesses, the implementation period for the new products is 1 year to 1.5 years. Okay. So it is having the development lead time, then productionization, then the PPAP from the customer. So lots of activities are there. So if there is an immediate drop in the sales, you cannot cover up with the new businesses. However, we have a new business, bookings are there, and there is a pipeline with which the SOP of the new products will come. So it is very difficult to say that whatever softening is there, it will be covered up, because it depends in which sector it is coming, whether it is a high volume, high value. So lots of factors are there. So generic statement we cannot make, but we understand the intention of your question. So we always work to reduce the impact of the market softening with the addition of the new products, new customers, new segments. So we will keep on working on that, and we will keep you posted on that.
Okay, sure, sir. Thank you very much for answering our questions, and wish you all the best.
Thank you, Umesh. Thank you.
Thank you. Anyone who wishes to ask questions may press star and one now. The next question is from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. And sir, congratulations, continue maintaining a top line above 400. And sir, my question is on the revenue mix side. On the PPT, we have given the 94% in the auto and 6% non-auto. So if you can explain segment-wise.
Yes. So we have noted in the last quarter the contribution mix. Passenger vehicle were around 38%. Then two-wheelers were around 43%. Commercial were around 12%, and non-auto were around 6%. So we have noted this. There was a movement, particularly in passenger vehicle, when we compared with last year Q2. We noticed a growth of 59% in the passenger vehicle. Even we noted a two-wheeler increase of 19%. But as Mr. Sham explained, we noted a down. I mean, you all know the downfall of market, especially for US and Europe for the commercial segment, because we are mostly into exports when we talk about commercial. We saw a dip of around 21% in commercial, and that would be one of the factors why even our gross margins were on the lower side than what we anticipated.
Sure, sir. And sir, just wanted to know, earlier we changed our strategy to diversify it more on the passenger vehicle compared to two-wheeler. But now, because of the rural recovery and other factor which is supporting two-wheeler. So now what our strategy, like CV also not doing very well. So now what are strategy going forward, and how much we are confident to maintaining that 2200 crore target by 27?
Yeah, Jyoti, thanks for this question. So our strategy is very, very consistent, and we are focusing more on the four-wheelers, especially on the passenger vehicles, commercial vehicles, and also more focus on the export businesses. As mentioned by Mr. Bimal in his speech, we are also focusing more on high value addition with shifting from as cast to as machine part. So our endeavor is there. However, as you mentioned correctly, we have seen in the last quarter, the sales in the commercial vehicle and the passenger vehicle were not good, and we have seen the decline. So to fill up the idle capacity, we increased our share of business for the two-wheeler. So those options are already available with us if we have to fill the idle capacity. But the long-term strategy will not change with the performance of the market in the one quarter. We are very much consistent with our thought process and the strategies which our group has defined, that we have to increase the top line, but we have to maintain very healthy bottom line also. So our strategy will be quite consistent in that.
Thank you, sir. And sir, on the margin side, what are our target and how we are targeting on the margin side, if you can guide us?
So margin side, what we are doing that, first of all, definitely there is an impact on the change in the sales mix. But continuously, one is that we are more focusing like what we are talking about. So we will see further improvement in the sales of passenger vehicles. We are having a good margin. And second is now, due to seeing the global issues, all these things, the market pressures. So in-house, the cost reductions, those activities also started. So to reduce the costs. So maybe we will see that the impact in coming quarters, Q3 and Q4, how the costs are going down, as well as maybe some improvement in the gross margins. So that is the way we are working to improve our margins.
Thank you, sir. And sir, if you can guide me on the market share side with the cylinder head and other parts.
1 minute.
Can you just repeat the question?
Market share on the cylinder head and new part side, if you can explain.
Okay. On the cylinder heads, yes, particularly four-wheeler, there is definitely a movement. This was also noted in the results. One is, yes, the volumes, what we are adding up with Maruti, with the upcoming launches, and also now addition to one location that has added to our sales opportunity. Second, also we explained on Toyota, where even they are going to come up with, they are talking about capacity expansion, so there is also an opportunity. Third is the Stellantis. There was a momentum in last quarter, volumes are picked up, so that will also add to this bucket. And now what is happening when we are supplying to these OEMs, to domestic as well as global, a lot of companies have recognized about the capacity capability of the volume what Alicon can deliver. So the inquiries have increased in that area. So we'd like to, going forward, definitely we see an opportunity to add further businesses with existing as well as some new customers in this domain. And talking about the new business, yes, basically, as we have aligned our strategy where we have defined very clearly which segments, which market, which customers to tap, and we have delivered few of the niche parts in past. So this is now demonstrating our existing and prospective customers. Also, what we have done is a lot of parts are of critical nature. A lot of parts are critical than the original ICE traditional parts, where even we talk about very low wall thickness compared to what traditionally people were manufacturing in our process of low pressure gravity. One example I'd like to share with you, it's a Volkswagen automation part. It's very critical part for 1.2 meter, weighing around 18 kg, which Volkswagen has given us an opportunity to excel how Alicon is. And we have delivered this part in the first sample. A very good sample was submitted to sample, and to their surprise, we have maintained the wall thickness which is ideally being achieved within a HPDC process. So this gave a lot of recognition, and they have shared a recognition, appreciation mail to us, and now they are talking about adding new other opportunities with the group company and other players in this space also. Also, secondly, we are working aggressively on automations. So in the last quarter, we have added 6 new robots in existing line, because whatever parts we are adding, it's critical in nature, bigger in nature. And even now, we have already submitted those samples of such critical parts, and in the coming quarters, we are working on the SOP of those parts. So these parts will demonstrate that, yes, Alicon have crossed or come to a second level of manufacturing when you talk about critical parts. And we are quite confident these products, once we go in SOP, will give an opportunity to add business with existing and add new customers in this space. So that is how we are working on new business going forward.
Thank you so much, sir.
Thank you. Participants, if you wish to ask questions, you may please press star and 1 on your touchtone phone now. The next question is from the line of Amit Agicha from HG Hawa and Company. Please go ahead.
Good afternoon, sir. Am I audible?
Yes.
Yes.
Thank you for giving the opportunity, and congratulations for good set of numbers. Actually, I joined the call late. I apologize for that. My question was with respect to the CapEx guidance for 25 and 26.
So for 24-25 already given 150, so maybe 25-26 there will be further addition in the capacities for the new businesses. So but it will not be in the range of 150 or maybe 200, but expectation is between 90 crore to 100 crores.
90 to 100 crores?
Yes.
And any revenue guidance with respect to focus on the international market?
Yeah, definitely. This will be more towards the critical parts what we added. Like, for example, we explained we have worked actively on automations, adding robots, because whatever parts now we are adding, it's of higher weight. Like a Jaguar part which we have developed in past, the short weight of that part is 30 kg, and it's with a high volume. So we know very well, in conventional way, with the manual operation, it's not possible. So we're working actively, and these are very critical parts, and also to add precision and increasing our manufacturing capabilities on that ground. So going forward, investments definitely will come up in such projects where we can offer solutions in more with automations.
So mainly what we are seeing that when we are moving towards the bigger parts, more critical parts, so somewhere we have to invest in our new equipments to handle those and more automation. So that for that we need the additional capacities.
Understood. So that guidance for 25 given was 1,800 crore, am I right?
Yes.
And for 26?
For 26 now, that's why we are saying that maybe in the next quarter we will be able to give more clear picture, because you know that we will have more clarity from the OEMs when they will give the full year volumes. Because because there is no consistency, we are seeing some softening in the market, in the global market. So that is why at this moment it looks a little difficult to give the guidance for that next year.
Understood. So the last question was with respect to the blended interest cost on the borrowings that we have.
Yeah. So at for the capexes we need the this debts. But if you see on the other side, even after having this the addition of 100 crore capex during the 6 months, still there is no big increase in the interest cost. So maximum we are managing through our internal accruals. So definitely we are focusing on this. Yeah. Sorry?
My question was interest rate, the blended interest rate on the total borrowing.
Total is in the range of 9.5%.
9.5%. Okay. Thank you, sir. That was helpful, and all the best for the future.
Okay. Thank you.
Thank you. You may press star and 1 to ask questions. Ladies and gentlemen, as that was the last question for today, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call, and we look forward to interacting next quarter. Thank you very much.
Thank you, members of the management. On behalf of Alicon Castalloy Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.